That's a good one, ISM. And we hear all of these crazy terms in our business. And this is a term that came out this week. And, obviously, Derek, you and I have been talking about this for many, many years. But there's a measurement that's out there that's an indicator of the health of the economy. And this week, we got an ISM number.
Right, and the ISM Services number, which is very important because services is roughly 70% of the U.S. economy, came in much stronger than economists expected at 54.5, the highest reading in 6 months.
And tell me about why that number is significant, that it is over 50.
Well, that's an expansionary number. So anything over 50 is expanding, anything below 50 is contracting. And one of the reasons the Fed has continued to raise rates is because the service sector remains so strong, job growth remains strong there, and wage inflation remains high there. So that strong number, again, caused many to believe the Fed will keep rates high for longer.
And so ISM above, and of course, in our country, 75, 80% of it is service related. And so the manufacturing number, however, has been below that. So it has been contracting. And so therefore, we see that you could have this rolling recession that we talked about some 6 months ago.
Right. Well, we talked about the differentiation between services and manufacturing benefited disproportionately from COVID as many people went out and bought products and things of that nature. But now they're doing things like traveling and going to restaurants. But the labor market does continue to be pretty strong. The job opening survey, still a lot of job openings, but fewer than before. So the labor market is starting to go in the right direction. And I think right now, Dave, just in generally speaking, we're kind of in a situation where many people believe the Fed has engineered a soft landing. If that is true, then stocks probably go higher through year end. If that's not, there's some vulnerability to the downside.
And we're going to find out more just a couple of weeks because they're going to have a meeting and the percentages chance that they're going to raise rates is very, very low. But you look at what's happening and you see some of the inflationary numbers have come down. In fact, if you take renter's equivalency rent out of that calculation, which is a big part of the CPI number, it's pretty low.
Right, it is, and it continues to be low. Owner equivalent rent has started to roll over, but it has been fairly sticky. The other thing that some people are pointing to are higher food and energy costs, which have started to perk up recently, but they're a smaller component. So the inflation fight seems to be being won, but on a very gradual, slow basis.
And let's talk about energy. Of course, we saw oil continuing to rally, and there's a lot of things that are happening. We heard that the Saudis were not going to go back on their cuts, going to keep them in place, and we're seeing oil prices come high, and it's a sector that you can invest in.
You certainly can. Very high free cash flow yields. The companies have been far more rational. They're not drill, baby, drill anymore, given the negativity from the administration towards carbon products. The other thing is that inventories are at historically low levels. The inventory levels are the lowest levels they've been since 1985. And when you think about it, with China sputtering, the economic rally there starting to sputter, if that starts to turn around, the squeeze in energy prices into the winter could be pretty severe.
Yeah, and we're going to have to watch that. And again, as an investing idea in a sector, it's something that you are watching. We have been overweighted in that area, and we've been underweighted in some of the more defensive sectors, like utilities and staples, but sometimes there's a reversion to the mean as well.
Right. The extreme levels that we're seeing in many sectors right now are at historic levels. A differentiation between the NASDAQ, say, and small cap stocks is at a record wide level. The differentiation between interest rates and PE multiples is also at a very wide level, which was one of the reasons why it's very hard to make a big bet in either direction right now, because the economic tea leaves are somewhat murky. Even the Fed acknowledges that. And the best way to deal with something like that is to have conviction, and basically having no conviction with regard to what your overall allocation is.
That's right. And of course, lastly, cash is not trash, and something you pointed out is that we have not seen interest rates on money rates above the dividend rate of the stock market in a long time.
Right. We haven't seen the earnings yield versus the Treasury yield at these levels since the dot-com bubble, and I don't have to tell you what happened subsequent to that. So it's not a bad time to be looking at Treasury bills. It's not a bad time to be moving money from, say, a bank account to Treasury bills where you're getting north of 5% yields. I mean, that's a pretty attractive number, particularly when you think that inflation is lower than that.